I want to start today's video off with the 50 basis point discussion because while I think that would be the right thing to do, it obviously probably was the right thing to do at the last meeting given the inflation and jobs data we've had since. Despite being a bear, I don't think that is going to happen. And I think that's okay. I don't think it really matters. What ultimately matters is the terminal rate, the final rate that the Fed gets to and holds for roughly a year or so. And 50 versus 25 basis points is really just a matter of a couple weeks. And the market is going to adjust to the Fed's guidance of where that terminal rate is, regardless of the pace at which the Fed actually hikes the Fed funds rate. So why do I think the 50 basis point hike is not going to happen? While some Fed members are saying there was a compelling case for it at the last meeting and they might support it at the next meeting, there are other Fed members who probably make up the majority who say, while we still want to get well above 5%, while we still want to hold rates high above 5% into next year, while we definitely don't want to cut rates this year, we still support the 25 basis point hike. It's that simple. They've made this downshift. It risks the Fed's credibility if they downshift to 25 and then have to shift back to 50. It's just not a good look. You know, I personally agree with Bullard's case. Like, we know that we have to get into restrictive territory. We're committed to getting to over 5%. Why don't we just get there as fast as possible? That's what Bullard's saying. I agree with that. They honestly probably should get there as fast as possible, but I don't think they're going to do that. That said, the risks that they're talking about, the reason why they shifted to 25 basis points, that is not occurring right now. The thing they were trying to hedge against, we want to see how things play out. We don't want to, cause too much economic pain. That is not playing out. Let's not forget, the Bulls case has totally evolved. It's totally changed over the past couple weeks. They aren't solid in that case. It hasn't come to fruition. They said, the Fed's going to have to cut rates. The Fed has to stop they're going crazy. They're going to crash the economy. That's what the Bulls were saying. They were just basically, in my opinion, complaining because they felt like they were crashing because their stock market portfolios were crashing, and they just wanted the Fed to chill out, back out. You're going to crash the economy. That's not happening, okay? And that's honestly a problem. We're seeing not crashing economy. We're seeing continued strong jobs market. This is not good for inflation. This is good for the economy, good-ish for the economy. It's going to leave us in a weird spot, honestly. We're seeing inflation reaccelerate. We had, very low inflation reads month over month in November and December. Then we got 0.5 in January, 0.5 month over month. That is very, very high. That is very, very high. That is 6% annualized. And let's not forget, this is against tougher comps, the CPI reads that we're getting now. This is like January, this time last year. We're in the thick of inflation at that point, or close to it. We're on the uptrend. So we're still getting pretty intense reads on inflation. It's not over. And the Fed has done a lot of hiking. Additionally, the bond market has adjusted to the Fed's hiking before the Fed has actually done the hiking. So the Fed has talked about this, the policy lags. Waller said the policy lags are actually shorter now than they are in previous instances because the Fed is communicating so well. They're forecasting what they're going to do so well that the bond market is able to react well ahead of time. So understand that. Everyone's saying, we got to down. The Fed said, and other people said, we have to downshift to 25 basis points because it might crash the economy. Well, the lags have gotten shorter. The Fed has said the lags have gotten shorter. And we're not seeing the impact on inflation. We heard from Barkin today. We're seeing it in some areas. We're definitely not seeing it in others. Ultimately, the effects of the tightening are not really taking effect yet on inflation because it's not showing up in the data that we're really slowing down inflation. Same thing with Bowman, said the same thing. We're not really seeing the effects of inflation on the data yet. So the Fed is not content with where they're at. They're going to keep going and keep going and keep going. And they don't want to just see just a tick down in inflation. They've said this before. Remember how they didn't want to cite one piece of data? They wanted to see 3 to 6 months of consecutive declines before, before anything at all, before even saying, okay, fine, we're starting to enter a sustainable path down towards inflation. We just reset that entire process in January. So all these people saying inflation is going to fall like a rock, they say that, and then the data looks the other way, and they don't change their opinion. They're entrenched in it. Like you could say the same thing about me. I'm entrenched in my downside. It's super easy to say that. Last week, guess what? Or 2 weeks ago, guess what? 2 weeks ago, we didn't have the data. Now we have the January data, and look how it looks. Next week, we're getting PCE. PCE is going to be very important data. We'll see how that comes out. It looks like CPI is going to be the coolest because that's the one that has the goods. PPI, very hot. PCE might be crazy. So let's all wait for some stuff to happen, and we'll see what happens. I'm still bearish. I think earnings have peaked and are beginning to contract. I think interest rates are going higher than the market has priced, and interest rates currently are very low, 10-year below 4%, pretty low. The Fed says they've liked the move that they've seen because 3.3% on that hawkish Powell didn't make any sense. The market just did a reflex or something and kicked it all right back because that was the proper response. So we're going to see what happens. We're not expecting a 10% drop in a day. I get it. There's a little bit of strength in the end of the day. Chill out, sit back, relax, trust in the fundamentals, and allow them to play out. Give them time. They're going to play out. We don't need to win tomorrow. We don't need to worry what's going to happen 5 minutes from now. Oh, the market went up, 10 bips. Don't worry about it, okay? Don't worry about it. Let's all chill out and trust in the fundamentals. Let them play out. It takes time. It doesn't happen overnight. There's obviously two sides to the market equation. There's plenty of crazy forces out there, but the bond market is telling us one thing. The bond market's definitely less crazy than the stock market. Acts more on fundamentals. It's only a matter of time before the stock market catches up. Basically has to if yields start offering a better rate of return. That's just how it works. It's a competitive market. That's just how capitalism works. So it's going to happen. That's today's video. Have a good weekend. Long weekend. Until next time, peace out.